Hey there, money mavens and future financial wizards. If you're sitting here contemplating whether to take out a loan, maybe to fund that exotic vacation, snag the latest gadget, or even rescue yourself from an unexpected rainy day, stop right there for a moment. Today, we're diving headfirst into the wild world of loans. Now, I'm not here to rain on your parade, unless it's a monsoon of bad debt. But taking out a loan is like entering into a long-term relationship with your bank account. It might seem all smooth and exciting at first, but before you're locked in for life with hidden fees, sky-high interest, and the looming possibility of collateral heartbreak, you need to know exactly what you're getting into. In the next few minutes, we're going to break down 10 essential things you need to consider before taking out a loan. From asking yourself if you really need that extra cash to understanding those pesky acronyms like APR and TAR. Stick with me, because by the end of this video, you'll be armed with the knowledge to dodge debt disasters and laugh in the face of financial pitfalls. Ready? Let's jump in and get this money party started. 1. Do you really need this loan? Or are you just chasing a fancy dream? Alright, let's kick things off with the million-dollar question. Do you actually need a loan? Or are you just dazzled by the allure of shiny things? Think about it. Sometimes, we're tempted to borrow money for things that might make our lives look cooler on social media, but may not actually add much value in the long run. Picture this. You see the latest smartphone ad, and suddenly you're thinking, I absolutely need that. But hold up. If you already have a working phone that doesn't explode when you call your mom, maybe you don't really need the upgrade just yet. Taking out a loan is a serious commitment. It's not like borrowing a cup of sugar from a neighbor. You're talking about a long-term financial relationship that can follow you around like that clingy friend who just won't leave. Before you sign on the dotted line, ask yourself, is this loan going to improve my life significantly? Or is it just a temporary thrill? Can I achieve the same goal by saving up a bit longer, or exploring alternative funding like crowdfunding, or even a government grant? How will this decision impact my future financial freedom? If you're leaning toward, I can wait and save up, rather than, I need this now, you might just avoid a world of unnecessary interest payments and financial headaches. Remember, just because you want something doesn't always mean you should buy it, especially if it comes with strings attached. I remember a friend of mine, let's call him Dave, who once wanted to borrow money just to buy the latest gaming console. Now don't get me wrong, gaming is fun, and I love a good console as much as the next person. But Dave's rationale was, I need this so I can relax after a hard day at work. Fast forward a couple of months, and Dave was struggling to pay back the loan while his gaming sessions became less about relaxation and more about stress management. Moral? Sometimes what looks like a small treat can lead to a lifetime of treat payments. 2. Pick your lender wisely. Not all money magicians are trustworthy. So you've decided you need a loan. Great. But here's the thing. Not all lenders are created equal. Some are as reliable as your favorite pair of old sneakers, while others are more like that sketchy street magician who promises to pull a rabbit out of a hat, only to leave you wondering if you just got swindled. When choosing a lender, you need to consider a few key factors. Banks and credit unions. These are your go-to reliable sources. They may move at the pace of a sleepy tortoise sometimes, but they're generally safe and regulated. Plus, you get that comforting feeling of everything's official here. Online lenders, fast, convenient, and accessible from the comfort of your couch. But don't be fooled by slick websites. Always check reviews and read the fine print. They might hide sneaky fees in the digital depths. Payday lenders and loan sharks. If a lender promises you cash faster than you can say, instant gratification, but demands repayment in what seems like the blink of an eye with outrageous interest rates, run faster than a cheetah on roller skates. These lenders often operate on the fringes of legality and are notorious for trapping you in an endless cycle of debt. The moral of the story? Do your homework. Verify that the lender is reputable, properly licensed, and recognized by financial authorities. In this world of too good to be true deals, if a lender is practically handing you money on a silver platter without any paperwork, it's probably a trap waiting to pounce. Always trust your gut, and a little online research never hurt anyone. I've seen plenty of ads promising quick cash without any fuss. They show happy people on beaches, exotic vacations, and the kind of carefree lifestyle you might envy on Instagram. But when you dig a little deeper, you find out that the quick cash comes with interest rates that could make your head spin. Think of it like ordering a burger from a fast food joint versus a gourmet restaurant. The fast food option might be quick and easy, but sometimes you get what you pay for, both in quality and in financial health. 3. Hidden fees. The sneaky little monsters lurking in your loan agreement. Imagine you're buying a car. The sticker price might look good, but then you find out there's a destination fee, a handling fee, and a smile fee. Okay, maybe not that last one. With loans, the hidden fees can add up faster than you can say, "Where's my contract?" Always ask, "What else am I paying for besides the principal?" That way, you're not caught off guard when the final bill looks more like a restaurant tab after a night out. Let's talk about the fine print. Now, if you've ever watched a mystery movie where the villain is hiding in plain sight, you know that sometimes the scariest threats are the ones you can't see coming. Hidden fees in loan agreements are just like that. They seem small and insignificant until they add up to a monster that gobbles up your money. You might think, "I'm only borrowing $10,000, so a couple of extra dollars in fees won't hurt, right?" Wrong. Loans often come with a slew of extra charges. Origination fees. These are like the setup fees for your new financial relationship. They cover the costs of processing your loan and can sometimes be a percentage of the loan amount. Appraisal and underwriting fees. Yep, those sound fancy because they are. But in reality, they're just extra charges for assessing the value of what you're borrowing against, or even just checking your creditworthiness. Late payment fees. Ever been slapped with a fee for missing a bill? Imagine that on top of a loan where every missed payment adds an extra charge to your debt pile. Prepayment penalties. Believe it or not, some lenders actually charge you for paying off your loan early. They want to ensure they get their expected interest. It's like being charged a fee for leaving a party early. The key takeaway here is, read the fine print. Take your time going through the contract, or have a trusted friend, or even a lawyer, help you out. It might seem like a drag now, but it can save you from a financial nightmare later on. Think of it as avoiding an unexpected plot twist in your very own money movie. 4. Can you really afford it? Let's crunch those numbers. Now that you've waded through the lender jungle and the hidden fee forest, it's time to ask the hard-hitting question. Can you actually afford this loan? This isn't a test of optimism. It's a reality check for your wallet. Budgeting might sound as exciting as watching paint dry, but it's one of the most crucial steps in ensuring that your loan doesn't turn into a long-term nightmare. It's like planning a road trip. You wouldn't set off without mapping your route and making sure you have enough gas, right? Similarly, you need to know exactly where your money is going each month. And trust me, those little luxuries can add up quickly if you're not careful. Imagine your monthly budget is like a giant pizza. You have your essential slices: rent, utilities, groceries, and maybe a slice for the occasional Netflix binge. Then there's the extra stuff, the toppings of life like dining out, hobbies, and spontaneous online shopping sprees. Now, if you borrow money and add those hefty monthly repayments to your pizza, will there still be enough slices left for your everyday needs? Here's a little exercise. 1. Write down your total monthly income. 2. List all your necessary expenses, think bills, rent, food. 3. Subtract your expenses from your income. 4. See if the leftover amount can comfortably cover the loan repayment. If your leftover budget is thinner than that last slice of pizza at a party, you might be setting yourself up for financial starvation. And trust me, surviving on barely there leftovers is no fun, especially when unexpected expenses pop up. Being realistic about your financial situation is crucial. It might be tempting to assume that a little extra expense now could lead to a big payoff later. But if you're not careful, you might end up living paycheck to paycheck, scrambling to make payments and wondering where all your money went. So be honest with yourself. If the numbers don't add up, it might be time to hit pause and reassess your priorities. 5. How fast can you pay it off? Or will it haunt you forever? Alright, debt isn't like that guest who leaves after a party. It tends to linger around, making itself at home if you're not careful. This brings us to the next big question. How fast can you pay off your loan? A long-term loan might seem appealing because the monthly payments are lower. But think of it like that one friend who overstays their welcome. They might be fun at first, but eventually you're tired of always having them around, draining your energy, and in this case, your wallet. If you can manage a slightly higher monthly payment, you could be debt-free in a fraction of the time, leaving you with more money to invest in your future. Let's break it down with a little story. Imagine you borrow money to buy a car. At first, the monthly payments seem manageable, but if the loan term is super long, you might end up paying for that car for 10, 15, or even 20 years. Over time, that lingering debt becomes a burden, eating away at your ability to invest, save, or simply enjoy life. Here's what to consider. Short-term versus long-term loans. A shorter loan term means higher monthly payments, but you'll be debt-free sooner, and you'll pay significantly less in interest over the life of the loan. Interest accumulation. The longer you take to pay off your loan, the more interest you accumulate. It's like ordering a dessert that costs $5, but by the end of the month, you've paid $10 for it because of interest toppings. Early repayment options. Some loans allow you to pay off the balance early without a penalty. This can be a great way to save money in the long run. But make sure to check if your loan has a prepayment penalty before you get too excited. It's all about finding the balance between manageable monthly payments and a reasonable loan term. If you opt for a long-term plan, just because it lowers your monthly bill, you might be setting yourself up for decades of financial bondage. On the flip side, if you can swing a bit more each month and pay off the loan quicker, you'll be free to redirect your money toward building wealth, rather than paying off someone else's dream. 6. Collateral. When your stuff is on the line. Now, let's talk collateral. Many loans, especially those with lower interest rates, require you to put up collateral. This means you're offering something valuable, like your house, car, or that rare vintage comic book collection, as security for the loan. If you fail to repay, the lender can take your collateral. Sounds a bit like a high-stakes game of don't lose your keys, right? Collateral is like putting your most prized possession on the line. It's not just about the money, it's about the risk. What if life throws you a curveball, and you suddenly can't make a payment? Is it worth losing your car, your house, or that limited edition collectible that you've had since college? Make sure you're comfortable with the risk before you agree to any collateral arrangement. Before you agree to use collateral, ask yourself, am I comfortable risking this asset? What happens if I face a financial emergency and can't make my payments? Is there an alternative that doesn't jeopardize my prized possessions? Collateral-based loans can be a double-edged sword. On one hand, they might offer lower interest rates and better terms because the lender feels more secure. On the other hand, if you run into financial trouble, you could lose something irreplaceable. It's like betting your favorite concert ticket on a coin toss. Thrilling, but risky if you're not prepared for the potential loss. Be sure to weigh the pros and cons carefully. If you're already strapped for cash, risking a major asset might not be worth the potential relief the loan provides. Instead, consider loans that don't require collateral, even if the interest rates might be a bit higher. Your peace of mind and your prized possessions are worth more than a marginally lower rate. 7. Worst-case scenario. Planning for the oops moments. Let's face it, life loves to throw curveballs. What happens if you suddenly lose your job, face a medical emergency, or if that unexpected crisis hits you like a ton of bricks? Before you commit to a loan, you've got to ask, what's the worst-case scenario if I can't pay it off? Planning for the worst isn't pessimism, it's practicality. Think of it as having an umbrella on a cloudy day. Sure, you might not need it if the sun comes out, but if a storm does hit, you'll be glad you prepared. An emergency fund is your financial umbrella, and having one can make all the difference when life throws you a curveball. Picture this. You've meticulously planned your budget, your monthly payments are all set, but then life happens. Maybe your company downsizes, or your car, your only means of getting to work, decides to take a long nap on the side of the road. Suddenly, you're staring down the barrel of mounting bills and penalty fees. Not exactly the dream scenario, is it? Here are a few things to consider. Emergency funds. Do you have a rainy day fund that could cover several months of payments if things go south? If not, that's a red flag. Backup plans. Can you rely on additional income, a supportive family member, or other financial safety nets? Having a plan B can be a lifesaver when things go off the rails. Stress testing. Think through various what-if scenarios. What if your income drops by 50% overnight? How would you handle your monthly expenses? Running these mental simulations can help you see whether your financial cushion is robust enough to handle unexpected hits. Planning for the worst doesn't mean you're pessimistic. It means you're smart. By preparing for potential setbacks, you not only safeguard your financial future, but also ensure that you won't be caught completely off guard when life throws a surprise your way. 8. Your credit score, the invisible report card. Now let's chat about your credit score. Think of it as your financial GPA, a number that tells lenders how trustworthy you are when it comes to paying back money. A good credit score can open doors to lower interest rates and better loan terms, while a poor score might leave you stuck with high-interest deals or even force you to turn to less reputable lenders. Your credit score might seem like an abstract number, but it's one of the most important tools in your financial toolbox. It determines everything from the interest rates you get to the kind of loans you can qualify for. It's like your financial reputation. And just like any reputation, it takes years to build, but only seconds to tarnish. So treat it with care, and always aim for that A+. Your credit score is influenced by timely payments. Paying your bills on time is like getting gold stars in school. It shows you're responsible and reliable. Credit utilization. This is the ratio of your current debt to your available credit. Keeping it low signals that you're not overextending yourself. Credit history. The longer your history of timely payments, the better. Think of it as building a reputation over time. If your credit score isn't where you'd like it to be, don't panic. It's never too late to start improving it. Make sure you pay off your existing debts, avoid unnecessary credit inquiries, and keep your credit utilization in check. Remember, every on-time payment is a step toward a healthier financial future. A solid credit score not only helps you secure a loan with favorable terms, it can also impact your ability to rent an apartment, get a job, or even negotiate lower rates on insurance. So treat it like the prized possession it is, and always aim to keep it in top shape. 9. Will this loan make you money? Invest in yourself or in a Mirage? Here's a question that many people overlook. Will this loan help you earn more money? Or is it just going to drain your bank account? There's a big difference between borrowing to invest in something that can yield future profits, like a business or real estate, and borrowing to fund lifestyle upgrades that don't contribute to your financial growth. Investing in yourself or your business can be a smart use of borrowed money, but if you're just borrowing to splurge on non-essentials, you might end up with a fancy toy and an empty bank account. Think of it as planting a seed. You want to plant something that will eventually grow into a money tree, not something that withers away before it even has a chance to sprout. Think of it like planting a tree. A good loan is like planting an apple tree that will eventually bear fruit, helping you pay back the debt while adding value to your life. On the other hand, a bad loan is like planting a tree that produces nothing but leaves, a lot of work, but zero reward. Ask yourself, is this loan going to generate income in the future? Or will the asset or investment I'm buying with this loan appreciate in value, or help me earn more money? Or am I borrowing just to keep up appearances, like buying an expensive car that depreciates the minute you drive it off the lot? Investing in yourself or your business can be a smart move. If you're taking out a loan to fund education, start a business, or buy an income-generating property, then you're essentially setting yourself up for success. But if the loan is for non-essential luxuries, you might want to reconsider, because in that case, you're just piling up debt without any long-term benefits. 10. APR, TAR, and other nerdy acronyms you need to know. Last but not least, let's decode the mysterious world of loan acronyms, APR and TAR. Now I know what you're thinking. Acronyms? Nerd stuff. But trust me, understanding these terms is like having the secret decoder ring for your loan contract. I know these acronyms can feel like they're straight out of a math textbook, but trust me, they're worth learning. Knowing how to calculate your APR and TAR will give you a clear picture of what you're really paying. It's like reading the nutrition label on your favorite snack. You wouldn't eat something without knowing what's in it, right? So don't sign on the dotted line until you fully understand these numbers. APR, annual percentage rate. This tells you how much interest you'll pay on your loan each year. For example, if you borrow $10,000 at an APR of 5%, you're looking at about $500 in interest per year. Simple, right? Well, it gets more complicated when you start adding in fees and different compounding intervals. But the basic idea is to show you the true yearly cost of borrowing money. A TAR, total amount repayable. This is the full amount you'll end up paying by the end of your loan term, including both the principal and all the interest. It's the big picture number that shows you how much this financial relationship will actually cost you. When comparing loans, don't just look at the APR in isolation. A loan with a lower APR over a longer period might actually cost you more in the long run than a slightly higher APR on a shorter-term loan. Do the math, run the numbers, and be sure to compare offers carefully. Remember, the devil is in the details. And sometimes the details come in the form of pesky little percentages. Extra tips and tricks for financial savvy living. Before we wrap up this epic guide, here are a few extra nuggets of wisdom to keep in mind. Stay informed. The financial landscape is always changing. Keep up with news, read articles, and if possible, attend workshops or webinars about personal finance. The more you know, the better decisions you'll make. Avoid impulse decisions. Just like that impulse purchase of a funky gadget that you end up regretting, impulsive financial decisions can haunt you. Take your time, consult with trusted sources, and always double-check before signing any agreements. Use technology. There are countless apps and tools out there to help you manage your budget, track your spending, and even monitor your credit score. Leverage technology to keep your finances in check. It's like having a personal financial assistant in your pocket. Ask questions. Never be afraid to ask your lender for clarification. Whether it's about fees, repayment schedules, or even the acronyms they throw around, clear communication is key. A reputable lender will appreciate your diligence. Plan for the future. Every financial decision you make today shapes your future. Think of your financial journey as a marathon, not a sprint. Each step you take, from budgeting to repaying loans, is a step towards a more secure future. Learn from mistakes. If you or someone you know has made a financial misstep in the past, use it as a lesson. Sharing stories, both the funny and the painful ones, can help you avoid the same pitfalls. We all make mistakes, but it's how we learn from them that matters. Keep a sense of humor. Money matters can be stressful, but sometimes a little humor can lighten the load. Laugh at your mistakes, celebrate your wins, and remember that every financial challenge is an opportunity to grow. There you have it. A deep dive into the 10 key things you must consider before taking out a loan. From assessing your real needs to understanding the fine print and preparing for the unexpected, this guide is your roadmap to making informed, smart financial decisions. Taking out a loan is no small matter. It's a commitment that can shape your financial future for years to come. By following these steps, you're not just avoiding potential pitfalls, you're setting yourself up for long-term success. Whether you're borrowing money to invest in your dreams, start a business, or simply get by during a rough patch, the knowledge you gain now will serve you well in the future. Remember, it's all about balance. Manage your money wisely, plan for both the sunny days and the rainy ones, and always keep an eye on your long-term goals. Financial freedom isn't just a dream. It's something you can achieve with a little careful planning and a healthy dose of common sense. So what's the final word? Before you sign that loan agreement, take a step back, ask the tough questions, and make sure you're truly ready for the financial journey ahead. And if you ever feel overwhelmed, just remember, you're not alone. There's a whole community of savvy savers, cautious borrowers, and financial gurus out there ready to share their tips and tricks. Thank you for sticking with me through this deep dive into the world of loans. I hope you found it informative, engaging, and maybe even a little bit fun. If you enjoyed this video, don't forget to like, subscribe, and share it with your friends. And if you have any questions or personal stories about your own financial adventures, Drop them in the comments below. I'd love to hear from you.